All right, try to keep things on schedule. We're going to get started. Again, my name is Bob Grossman. This is my esteemed partner, Melissa Bizyak, who,
Hi, the tiger.
Yeah, when you hear that music, you almost feel like exercising, almost.
No, I just feel like duking it out with you.
Yeah, I'll duke it out with you. Watch it. Melissa's a partner in charge of our business valuation group. She works in that group solely. I split my time between valuation and corporate taxes and business taxes. So we see a lot of things in the context of business valuations. And this summer, we have a huge development that we've been trying to get our arms around, along with about 50,000 other valuators around the country, with respect to affecting discounts and premiums, and primarily discounts as it applies to the valuation of privately held business interests. So we thought today we'd give you a little bit of a primer on the discounts, just a review for those of you that have seen it more often, and a primer for those that haven't, and then let you know what this development is and the regulations that have been proposed by Treasury in conjunction with these rules. The issue at hand is basically transfers of businesses. And in almost all instances, it's dealing with the idea or the concept of dealing with businesses and the transfers of those businesses among family members. And generally what we're talking about, generally what Melissa and I are asked to look at, is this conceptual idea of moving business interests from senior generation to junior generation. And it's probably an important political animal as well, in that the ability for people to efficiently and cost effectively move value and move the ownership of those businesses from senior generation owners to junior generation owners puts ourselves in a circumstance to be able to maintain the jobs that have been created under the senior generation's leadership, and basically leave enough money in the company to facilitate future ongoing growth. If we're going to tax the snot out of the value coming across just because dad gives the business to son and daughter, we're going to have a much less efficient system. And so that's what the estate and gift tax law is kind of constructed around on the transfer of these interests. The IRS has a problem with the general idea of discounting some of these ownership interests for a lack of control when the son or daughter doesn't have the control, simply because the dad does. That's one of their issues, and we'll talk about that some more. And they have a problem with the way that we as a valuation community have been doing valuations, though we're following standards and we're following what we would call generally accepted valuation principles in the work that we do. So what we're going to talk about a little bit is the valuation process with respect to those, and then we'll get into these proposed regs and tell you where the issues are as well. Obviously, when you're using discounts and premiums in conjunction with valuations, it's not a literal statutory item. It's not a given. It's simply a factual matter in conjunction with the valuation. So the law in and of itself, as it has been constructed over time and it has been respected by the courts, is primarily tied into looking at discounts as an item of fact. And you don't get a statutory break on that. So you have to prove it each time out. Now, valuation itself, and a lot of you in the room have had us help you with valuation matters at some point in your corporate or business existence, realize that it's not an exact science, and it really is judgmental in a lot of ways. And what we're looking at is the fact that it's not an exact science. So as you can see on the slide, and this comes out of an old revenue ruling 5960, which is kind of the foundational block at the bottom of the pyramid on which everything seems to be built up on, is you have to consider all the relevant facts. And if you think about these four, as we go through this morning's discussion, you'll see that there's some controversy with the proposed regulations, even against these four interrelated concepts. Also, you have to use some common sense. I mean, we see people bring to us valuation conclusions that really aren't rational. Third is informed professional judgment. Hopefully, Melissa and I have been able to establish that over a number of years of doing this. And then a reasoned out assessment and evaluation of the factual data behind the item. That's really where we're at. And so that's the basis on which you'll see us building our discussion as we go through. Yes?
So I'm going to go through some of the fundamental concepts that we have when we're applying these discounts and premiums. And I know most of you in the room have heard us before talk about the available discounts or adjustments that we take to gross value of a business or an entity and we take these haircuts, if you will, in the form of two major discounts that Bob and I are going to get into today and talk about how they're being attacked and what are the ramifications of these proposed regulations. So first and foremost is a discount for lack of control and then a discount for lack of marketability. But the fundamental concepts that are underlying these discounts are a number of things. The first and foremost is fair market value, and that is the standard of value that we're required to use for federal, state, and gift tax purposes. So this idea of fair market value is actually set by the market. It's a hypothetical transaction between a willing buyer and a willing seller. And when Bob just talked a few minutes ago about using common sense, when you have a situation where you have a valuator that's taking a 70% overall discount for lack of control and lack of marketability, does that really make sense to a hypothetical willing seller? I think you become less of a willing seller if somebody's going to discount your interest by 70%. So this idea of fair market value is set by the market. Obviously, another factor, fundamental precept or concept that we're looking at is that investors are risk adverse. So the higher risk that is perceived by a particular investment, what happens? Well, you want to be compensated more for that, so the lower the value. The base of application must be defined. So the base to which we apply our discounts, we actually have to have a clear and concise idea, or we have to have a clear and concise base to which we know, okay, we can apply the discounts that we are looking to apply are actually applicable in this particular situation, and we'll talk about that in a minute. One thing that we stress all the time is there are no prescribed levels or ranges of discounts or premiums. We used to hear that, hey, if you apply a 30 or 35% overall discount on your estate or gift tax return, the IRS isn't going to look at that. But that's not true, and that's where you get into trouble. Discounts for lack of control and discounts for lack of marketability, the main two discounts that we're talking about here, are separate and distinct concepts. Although you would think that there is some overlap, because if I do not have control over an entity, my interest is less marketable than Bob's if he has control over that entity. So there is some crossover, but we treat these as separate and distinct discounts and measures. Discounts for lack of control and marketability are applied multiplicatively rather than additively. We see a common mistake when somebody is applying a 20% discount for lack of control and a 25% discount to lack of marketability for a particular interest, and adding them together and saying, well, it's 45%. Actually, it's not. It's closer to 41, 42%. Standards of value that we're working with. In this area of estate and gift tax, it's always fair market value. So that's where we have that hypothetical willing buyer, willing seller, and they're both willing and able to transact. Other standards of value that we look at would be fair value in two separate contexts. One context would be in accounting pronouncements and financial measurements, and the other one would be state statutes if you have a pressed shareholder or dissenting shareholder situation. And in those instances, discounts are hardly, if ever, applied. Investment value, totally different situation of value where we're looking at a premium over and above fair market value for the ability of the potential purchaser to recognize certain economies of scale and synergies, which would push that price over and above fair market value. And then this idea of intrinsic value, we see sometimes in divorce court situations. I know that that's the standard of value in New Jersey, not something that we see quite often. But some of the factors that influence the applicability and the size of the discounts and premiums that we use, obviously, first and foremost, is going to be the purpose of the valuation. So if the purpose of the valuation is going to be for state and gift tax purposes, and we're following the current regulations and pronouncements that are there and applicable valuation standards, we're going to be applying discounts for lack of control and lack of marketability. But if you think in other contexts, such as an ESOP, that we're required to look at fair market value, we might be tempering that discount for lack of marketability because due to the put option that's available to participants in an ESOP, that actually enhances their marketability, so that marketability discount would be lower in size or smaller in size. Obviously, and first and foremost, we're looking to the attendant rights and characteristics of the ownership interest that's being valued. and any restrictions on that particular ownership interest. So what we're looking at is the bundle of rights that are associated with the particular interest that we're valuing. The ownership structure is very important. There's always a distinction if you have a recapitalization of your entity and you have voting and non-voting stock. Voting stock is going to have a slight premium over non-voting stock. That makes sense. There are different discounts that are available, namely a discount for lack of voting rights in situations like that. Other factors would be quality of the management team. If you have a thin management issue, strained family relationships, that would have a bearing on the size and the applicability of the particular discount. The one thing that Bob will always caution when we're working in that realm is you don't want to double count the discount. So you don't want to consider that a risk when you're coming up with the value of the entity under the income approach, and then you don't want to consider it again when you're applying a discount for, let's say, lack of control or lack of marketability. The size of the company is very important. Large, multifaceted businesses are certainly going to have lesser discounts. There's an inverse relationship between size and value. The size of the block of stock, one of the things that we look at is a swing vote characteristic. If I have 249% holders in a company and I own 2%, the value of my interest would be significantly more if I own 2% and the remaining 98% was split between 8 different people. Because I would have the ability in the first situation to align with one of the 49% interest holders and effectuate some type of control, taking us over to that 51% control situation. Another thing we look at is propriety of management salaries, perks, things like that. If I'm valuing a non-controlling interest and we see that salaries and perks for the controlling interest holders are above what is acceptable and they're discretionary, we're going to take a discount for lack of control, but not making sure we're not double counting the harm in that situation. Stock-related issues, dividend policy is very important. If there's a history of dividends and distributions from a company, that's obviously more marketable. An equity interest in that company is obviously more marketable than an otherwise identical company that's not making dividend distributions. Financial condition of the company is obviously another big factor in determining the level and the applicability of discounts and the volatility of earnings as well. The last thing we look at is the federal and state federal and state regulations. So especially those that are the ones that we're going to talk about today are the ones that are governing gift and estate tax valuations, but we're also mindful of those regulations that are in place with the Department of Labor as well as the IRS with respect to ESOPs. They have their own nuances that we need to be aware of. The factors that, additional factors would be state corporation statutes. So if we're in New York and Illinois and it requires supermajority, we're certainly not going to be taking a discount for we're going to be taking discounts for lack of control if we're valuing a 55% interest because you're required to have a supermajority to effectuate control. Market desirability is something that comes into play looking at struggling versus a thriving industry. Potential synergies, if any, with the buyer is another factor. The other thing that's huge with respect to determination of the size of the discount would be the investment time horizon. The longer you're going to hold on to that interest or the perceived holding period, the higher the discount.
Yeah, so that brings us then to understanding levels of value and how levels of value influence the application of discounting. Understand that primarily what the discounting is all about is the company's worth $10 million. The parents want to transfer certain ownership to the children. They have 2 ways to do it. They can sell it, which is rare because the children don't generally have the resources to facilitate that kind of transaction, or they can simply gift it. And so the idea is if they gift it without discounts, whatever they gift is worth a proportionate piece of that $10 million. So what people do is we create situations. When I say we, I'm talking about the attorneys in the estate planning community and valuators by basically bifurcating the value. So if you own control of 10 million and you're transferring controlling interest, it's worth just that percentage, 10% of the 10 million if that's the gift. If that value exceeds the $14,000 per donee each year, you can do gift splitting 28 for a couple, or it goes beyond using the entire lifetime exclusion, which now sits at $5,430,000 or $11 million for a couple, approximately. you have a problem because you have to pay transfer taxes, the so-called death taxes that we talk about. So the idea is to carve the business interests up into a manner which allows to project and send out these non-controlling interests that Melissa alludes to get us into a framework where they don't have any control, which represents a risk, right, because they can't facilitate the control. And it also has a limitation on marketability, primarily because we build marketability into the governing documents that the lawyers draft. So that's the perspective that we take as part of the estate planning community on moving business value from senior generation to junior generation. That's what the IRS takes exception to, so in certain instances. So if you look at the levels of value, we have multiple values. The big three are what we normally see. So if you see a company that Dad owns 100%, and we're going to do fair market value calculation, we're going to look at that on a controlled marketable basis, meaning that he owns 100%, so he has perfect control, so there's no risk associated with a lack of control. And then he has a marketability feature to it because he's the guy that calls the shots. He can sell it if he wants. So he has less marketability restriction or risk than a minority shareholder might have that's limited on the transferability of that interest by virtue of the governing documents. There's still a marketability discount, to be sure, in a privately held enterprise, and we'll touch on that real briefly this morning. But the idea conceptually is that he doesn't carry the risk in a controlling interest environment that a minority interest holder has. The next level is kind of a marketable minority value. And historically, if you think about that as publicly traded shares, that you or I own in General Motors, we all own 10 shares of General Motors stock. Well, it's clear that we don't have any control, right? We have no voice, but we have a perfect market to sell it, call a broker and exchange it. So if we carve out the marketability feature on a minority interest transfer in a privately held enterprise, there's room to compensate downward value adjustments for this lack of marketability. And then finally, the stage that we generally try to get to is non-marketable minority values, meaning, again, they lack control, the agreements and the marketplace is such that there's no marketability, and we get those restrictions. So that's the primary three levels of value. In assessing the advantages of control, and I'm not going to go through these because time doesn't really allow, but you can see the kind of things that we're talking about. If you think about value in its very simplest context, all value is forward-looking. So if you simply take a capitalization model and you say, we expect all future cash flows to be $10,000 a year, and that's going to be our base number, and we take our risk rate, a discount rate that we subtract off what we would call a long-term sustainable growth rate, the expected future year's growth, and we say our risk rate is 20%, then the answer to valuation is very simple. It's just the 10,000 divided by the 20% is a $50,000 value. That's the answer unequivocally. So if you have the capability and the power in the equity interest that you own in any enterprise that allows you to influence the amount of that income or expected future economic benefit and the timing of that economic benefit, that will bring you back to compensating for the risk, because you have your own ability to shake that risk through your own capabilities, if you will. Not that you won't run it into the ground. I mean, we see that happening too, but the thought process is you have the control. And that's really what we're talking about, changing or protecting that future economic benefit or modifying the risk in the enterprise so that the risk rate's not 20%, but rather 18%, if you will. So when you do that, you have to move into assessing levels of control, and that's where you're at, right?
Yeah, basically, this is really a repeat of some earlier slides when we talk about what has a bearing on the applicability and the size of the discount. When we're assessing levels of control, we're obviously going to be looking at certain factors that will have a bearing on the degree to which we're going to provide a haircut in the value ascribed for this restriction and control. So obviously we're going to be looking at industry regulations that may limit advantages of a controlling shareholder. state corporate and entity laws, voting rights we talked about, if someone has a voting right rather than having an interest with a non-voting or holding non-voting interests. Financial condition of the business, size of the block of stock obviously is going to have a bearing on it. Concentration of ownership, like I talked about with having that swing vote, the degree of lack of control is going to be significantly lower than another interest that I talked about that has a different dispersion.
Yeah, each of those items that she's covering, I mean, those are considerations that Melissa and I look at continually when we're determining the level of the discount. Not necessarily whether the discount applies or not, because at this juncture, we kind of feel like it does apply. So we have to go through and we have to assess, well then, what is the issues? What are those specific risks that are presented by this lack of control feature attended to that equity interest?
And just three other broad ones is participation, representation on the board of directors, obviously will have a bearing. Contractual restrictions, if there are loan agreements and restricted covenants when dealing with the availability or applicability of distributions from the privately held interest. And then other agreements as well, we're going to look to restrictions that are contained in a governing agreement that would be a buy-sell agreement.
Yeah, so moving on from there, you'll remember on the fundamentals that Melissa was going over initially, she talked about no discount is correct until the platform on which it's to be applied is determined. And so when you have those three levels of value, control marketable, as I said, and then a marketable minority interest, and then a non-marketable minority interest, depending on where you fall out under the general calculation methodologies will determine whether or not it's appropriate to apply a discount or not. So we look at these different approaches, and there's three primary approaches that everybody's familiar with, if not by virtue of business valuation, simply by virtue of seeing real estate appraisals over your lifetime, perhaps for a house or so forth. So there is an income approach which looks at the associated economic benefit streams going forward, brought back to present values or date of valuation considerations at a risk rate specific to those cash flows and the circumstances. Then there is a market approach which allows you to go out and basically look at other houses in the market and bring it back. So that poses a difficulty in that, you know, if you have a house for sale and there's a house right across the street that was built at the same time, looks just like it, and sold for $300,000, then you know your house is probably worth approximately $300,000 if it's in the same condition. Of course, when you have privately held businesses, no two are exactly alike, and that's what we wrestle with in our group, is finding what we call sufficient similarities to be able to use those market indices. And then the last is the asset approach. So each of those may produce a different level of value, bringing out the process of landing on a certain platform. And we're not going to spend the time today because time doesn't allow for it, but the conceptual idea then is to know what approaches are being applied in the business valuation, where do they land on that three levels of value, and then if the project that we've been asked to do, you know, we started with a control marketable value, but the assignment is to value non-marketable minority interest for purposes of transferring it into state transaction, then we know we have to take the discounts. And that's the point of the slides. So I'm just going to bypass that. So there is this spectrum of control, and I think that's the thing to understand, because control is where most of the bargaining comes into play with the IRS on intra-family transfers in particular. At 100%, you have perfect control. So if you own 100% of the company, of course, there is no risk attendant to a lack of control. Now, if you have 95%, the question is there a discount for lack of control? Well, you still have control, but you have, you know, what we refer to as kind of pain in the rear problems, because you have a minority shareholder. You still have to answer up to that person, and you have fiduciary responsibilities under state laws in almost all jurisdictions. So it's not the same as perfect. It's probably not much less. There's probably not a lot of a discount there. And then it increases and builds all the way down. Obviously, you have control interest with liquidating control. Melissa spoke of supermajority states versus general majority states. You have 51% operating control, which is in most states is a significant level to be at, of course. You have two equity holders each with 50%. Does either one of them have control? No, but they both have the ability to block the other shareholder, or the other equity owner, So it's not the same thing as minority. And then you move down with these other blocks, the minority with the largest block, the minority of the swing vote attributes that Melissa alluded to, and the minority with the cumulative voting rights, and then the pure minority. So you go from perfect control, no discount, to perfect minority with a maximum discount depending on the risks attendant. And that's really the way we look at that issue.
So once we've established our opinion of value and where we fall out on that chart that Bob was talking about, and then we look at our continuum of control here and we apply our discount for lack of control and make sure that we can defend the level of the discount, we move on to what the next discount is, the discount for lack of marketability. We understand that a closely held business does not have that component of marketability. If my interest in Grossman, Yannick, and Fuller LLP, I can't call John Yannick and say, hey, I want to liquidate my, unless he has amended and restated the partnership agreement, I can't call and say, hey, I want to liquidate my interest. But what can I do if I own PPG stock? I can liquidate my interest and convert that to cash in pretty short order. So the definition of marketability is such that it's the ability to convert the business ownership interest at whatever ownership level that you have. It's that ability to cash out quickly with minimum transaction and administrative costs, in so doing and with a high degree of certainty of realizing the expected amount of net proceeds. So that is on one level, as you go through the continuum of control, we have a very similar continuum with respect to marketability. So we have pure marketability up here for a publicly traded company, and we go down the whole way to a minority interest in a privately held business with zero ability to have marketability.
Yeah, the origin of marketability discounts, and just to touch on, is rooted in this revenue ruling 77-287 in front of the IRS. So it looks at the 1971 SEC institutional investor study and basically sets a number of factors that are to be considered in determining the relevancy and the applicability of marketability. A great many cases in tax court and appellate court since 1977 have been centered on this specific item, the lack of marketability and how to calculate that. There's a lot of empirical evidence that's available out in the marketplace. It's all kind of imperfect, so it takes a lot of judgment to make these determinations, and the service is constantly arguing. But the idea is to look at the primary considerations and rooting all the way back to 77-287. And again, there's been a lot of history since then that we pay attention to. It's net earnings, net assets, and net sales. To give you an idea, I mean, a company that has a marketability issue, that has low earnings or low net assets, has a higher risk of being able to be converted and liquidated by selling it than a company that's very strong, just because it has a more formidable base of future expected economic returns. With respect to control interests, and we're not going to spend a lot of time talking about them today, but there is an argument out there that even controlling interest, as I mentioned earlier, has a discount for lack of marketability. If you have perfect control, you're not going to have a control discount applied. But marketability, you very well may, because we have people come to us all the time, and the partner group at Grossman, Yannick & Ford, we've probably handled 100 transactions in the last 5 years. You know, it takes time to sell a business. It takes time from the time the partner comes in and wants to do it until we go through the 9 yards to get it ready, find a broker, get it sold, structure the transaction, and then get the proceeds. So that in and of itself, that time horizon is the problem. And that presents a lot of risk, because there could be volatility in the value of the enterprise between that first day when we say we want to sell it for $10 million, and 18 months later when we close it at $7,800,000 or whatever it's negotiated. So these are the kind of items that we look at: the uncertain time horizon, the cost to prepare and execute, the risk as to eventual sales price. Deferred proceeds and non-cash proceeds present a problem in doing that, and the ability to leverage the value of the enterprise in the interim. So you can't really go out and borrow against the $10 million hedging your bets. You have to wait as well. The items that we see increasing discounts for lack of marketability are the ones you see on the screen, and they make sense. They're logical. The restrictions on transfers of stock primarily is the big one that we see over and over again, which is a problem for the IRS. Little or no dividends or partnership payouts. If you have a marketability issue associated with a minority interest, if there are amounts being paid out as cash flow every year, That's a lot different than if you have no control, you have no marketability, and you're not getting any payouts. So cash flow and dividend payments and partnership payouts are a big deal. No prospect of selling the company and limited access to financial information.
On the opposite side, the factors that are going to decrease are just basically the opposite of what Bob was saying. The longer that you know that you have to hold on to the interest, obviously is going to increase your discount. But if you have the ability to shorten your holding period, if there's a buy-sell agreement that states that you can place your shares back to the company or to the rest of the partners or shareholders, obviously that's going to decrease that. And if you're receiving cash distributions, cash dividends, that's something, receiving a return on your investments, that's something that is also going to decrease your discount for lack of marketability. And obviously, which is a rarity, but if there's a imminent IPO of the company or a sale is imminent, that is going to decrease your lack of marketability, obviously because that that holding period is lessened. There are factors that could increase or decrease the discount, and obviously the size of the block of the stock will depend on the size and degree of marketability, and then the presence of a buy-sell agreement that has provisions that speak to an available market for the particular interest.
Yeah, so I mean, if we talk just for a moment with that little brief primer on discounts and how we look at them as part of the valuation community at large, you can start to assert and understand where the IRS starts to have some concerns. If you have that $11 million exemption, meaning during my lifetime, my wife and I can join together, we each have $5,430,000 of value that can be transferred before we start to pay taxes, before we start to pay death taxes on the transfer. So if you have a company that's worth $14 million and you want to move the whole thing, if you move it in one block, you have $14 million minus the $11 million lifetime exclusion, and you have $3 million of value that's subject to an estate tax transfer. It actually would be a gift tax if it was done inter vivos. So what would happen is you'd pay on that $3 million, probably $1 million in taxes to transfer that business to your children. On the other hand, if you fractionalize it, meaning you bifurcate it into non-controlling, non-marketable interests through transfers of minority interests with restrictions on transferability, then you may be able to take discounts. It reduces the value from 14 million to 11 million, and now you transfer the entire business without any death taxes, and the IRS is out there $1 million. So that's the purpose and the structure behind it, and that's the general throes of what's gone on. What happened this summer was there was a set of regulations issued on August 2nd that appeared in the Federal Register on August 4th. These were regulations that were expected last year around the middle of September of 15 and were basically almost a year late. These are a very controversial set of regulations, but what they're looking at on these regulations is trying to get a grip on what the valuation discounts are in certain limited circumstances and trying to curtail those by attacking certain applicable restrictions and disregarded restrictions that are basically not considered or not to be considered in the conjunction with a transfer of an ownership interest in an intra-family transfer. And we'll get into a little bit about what that means. But these obviously are important regulations that are currently in play right now. It's interesting, based on the outcome of the presidential election, to kind of pose queries as where this might shake out now. But this is a long-running argument with the service. They hate the discounts, especially when the family owns the ownership interest before and they own the ownership interest after. The family, not that specific interest, of course. And so they like to look at it from the means of attribution. This has been going on for most of my career. For 35 years, we've been fighting this argument with the IRS and how we bring this forward. So the historical background of this is there was a revenue ruling 81-253, and by numbers, for those of you that aren't tax geeks, the 81 is the year, so it goes back to 1981. And in that case, what they said was that my daughter, my son, my wife, through attribution, and attribution has its own specific definition that we won't get into today, it's a technical issue, but basically saying everybody in the family owns what everybody else owns. So even if I give my daughter 10% of the company, then in that circumstance, she will have owned 10% directly, but she's also deemed to own 90% indirectly, so she owns 100% of the company. She has perfect control at 100%, no discount. So that was their finding. And they did that purely on the basis of family attribution, the fact that the family owns it before and after the transfer. Now, the comeback to that was a number of cases. The first one was called Estate of Bright, but there was an Estate of Andrews and Estate of Popstra. And these cases all ruled the same way, that when you're doing a valuation in the context of an estate and gift tax transfer for fair market value purposes, and Melissa defined that a little earlier, what we're in fact talking about in that instance is the equity instrument itself, not in consideration of who holds that equity instrument. And the language in the Estate of Andrews was particularly informative in that the judge said it would be strange to value an asset based on a particular holder. So the idea is you're valuing the asset as a general risk incentive based on a hypothetical holder and not a specific holder. And that's what the history has been. So 81-253 basically said that was not the way they were going to look at it, even after the Estate of Bright came out. So that continued on until the 86 Tax Act. There was some room for changes through the 86 Tax Act. Nothing really happened. And they issued in 1993 Revenue Ruling 9312. 9312 is really the foundational tool that has driven the entire family limited partnership industry for the last 25 years in the country, or 23 years. And really all that 9312 says is what I said at the very beginning on the very first slide, is that the IRS does not guarantee by virtue of that pronouncement that you get a discount, but they're saying if the facts and circumstances merit a discount, it's not going to be disallowed simply because of the family ownership. So because of that, we were able to go out and start fractionalizing interest, a lot of these family limited partnership transactions, and at the end of the day, take pretty substantial discounts, and that's been the course of action since the release of 9312. Now, in 1990, and Melissa's going to talk about it just in a moment, there was an introduction of another set of rules, which was considered Chapter 14 under the estate and gift tax parts of the Internal Revenue Code. And those rules in particular set limitations on transferability of ownership interests from senior generation family members to the lower. And those are called the Chapter 14 rules, sections 2701 through 2704 of the code. And Miss is going to go through those real quickly.
Yeah, so 1990 is when Chapter 14 was introduced, and they're establishing these rules for valuations of intra-family transfers of equity ownership interests for estate and gift tax purposes. So briefly, here they are. 2701, just going to help you provide guidance on what constitutes a gift in interest of corporations and partnerships. 2702 is dealing with gifts and trusts. 2703 actually speaks to fair market value, and it provides guidance that if you have restrictions in a governing agreement, those restrictions can't be any more restrictive than if it's dealing with an arm's length transaction. So it can't be a vehicle to transfer an interest of an appreciating property from senior generation to junior generation at a higher discount than would otherwise be available to a non-family member. But this is 2704 A and B is where all the magic is happening, and this is where the proposed regs are attacking. First, A talks about lapses in voting and liquidation rights. So an entity that's controlled by a family member, by a family before and after the lapse, then the lapse should be disregarded pursuant to this part of the code. And then 2704B speaks to what an applicable restriction is. And an applicable restriction is any restriction that limits the transferee's ability to liquidate, which then lapses or can be removed by the family after the transfer of the equity interest has been made. So this is where the proposed regulations are going to start attacking those level of discounts. But understand that the key concept right here, and the play is in these applicable restrictions. Because right now, certain restrictions set forth in a governing agreement, so that could be an FLP agreement, a buy-sell agreement, they'll be respected when we are determining and quantifying our discounts for lack of control. But other restrictions that are in the code and labeled as applicable restrictions will be disregarded and effectively dismissed when we're quantifying our discounts.
Yeah, so I mean, applicable restrictions is at the heart of this. And that they're at the heart of this issue that these proposed regs are attacking, simply for the reason that Melissa just said. It's the most important part of this this presentation, that applicable restrictions, if those restrictions are in the agreements are found to be applicable restrictions, are not to be considered by the valuators in conjunction with doing the valuation of those interests. Meaning, of course, that we value it without it, and you're going to end up with higher values. If you have restrictions, greater risk, lower values. And the opposite is going to apply if these rules are adopted and applied. So when we look at these, and where the rules are and the risks with the IRS and their concerns, they're specifically, they concern the treatment of these lapsing rights. And when we say lapsing rights, to have a feel for it, there's a restriction in an agreement that the holder of the interest has. It could be for anything, on liquidation or anything else. On their death, that restriction lapses. But immediately before they die, that lapse is there. So it's within the family's control, and ultimately what the service looks at this for is there's really no restriction at all whatsoever. They're suggesting that even though it's in the legal document, it's not more restricted than governing law. The fact of the matter is it goes away immediately after the death. But at death, it's there. So if it's at death, our position is we discount it. They're saying it comes back the day after and that value hasn't really been lost. That's one of their concerns. The other is the undervaluation that results from that because it drives up the taxes. In my example, if those were applicable restrictions that allowed for the discounts from 14 million to 11, then they were going to put $3 million back in the estate, arguing that we've undervalued the estate by $3 million. So they do that, as we said, by this applicable restriction definition. And Melissa went over it real quick, basically a restriction that limits the ability of the partnership, and it's been expanded in these rules to corporations and limited liability companies to liquidate. Okay, so that's one of the restrictions, and such restriction lapses after the transfer or the transferor and the members of his family alone or collectively have the right to remove the restriction. So it either goes away immediately at the death of the holder, or there's an ability to get rid of it by virtue of the family vote, and that's what they're really looking at as well. As Melissa said, the current rules provide that a restriction is not really an applicable restriction if it's not more restrictive than the current laws. What's happened over time is as people have modified their laws to accommodate the estate planners. Texas in particular has a lot of assignee assignment laws that were put into the Texas legislation, unbelievably, to circumvent the IRS and the federal code. So, that's the power of lobbying by wealthy oil people. The other thing is the proposed regulations. And the proposed regulations that are coming out are basically looking at these lapses as being a transfer of value. So if you're gonna value the entity interest in consideration of the restriction, then they're gonna treat the fact that the entity value, not the entity value, excuse me, but the restricted provision in the agreement, the fact that it lapses, they're gonna accord a value to that, which is gonna get you back to the same end as well. The key concept in all of this is obviously is the family and family control. So what they're going at, again, is getting all the way back to their position in 81-253, 35 years ago, and trying to make this argument that family attribution matters in conjunction with the values. So they've changed that, and where you have families controlling the enterprise before and after, these rules, if adopted as proposed, would end up eliminating a lot of the discounts that we've used in the past as well. The shortcomings that they're trying to address with these new rules, these proposed rules that came out in August, is a lack of overall effectiveness of the current regulations, the 2704 regulations. Those provisions were passed in September of 90. The regulations were out in 92, about 18 months later. So they've had those same 2704 regulations for a long time now. They don't think it's really doing the job. They've tried to defeat it a couple of times through congressional action, but it's never really gained traction to get all the way through the process. And even laws that have been introduced to make this set of proposed regulations more akin to law instead of regulation has failed along the way. So restrictions under state law that defeat the intent of rules are no longer going to be respected. They've had a problem with that, as I mentioned earlier. The transfers to non-partners and non-traditional equity holders, such as assignees, are avoiding the reach of the rules or the intent of Congress in passing Chapter 14. And then finally, the transfers of nominal interest. We've seen a lot of transactions over the years. I mean, one thing you say for attorneys, they're very clever. And what they've done is they'll assign a small fractional interest in the company, perhaps 5 or 6%, to a charity, perhaps a college, a university, or a church or something, so that they don't have perfect control in the family anymore. 6% belongs to somebody else. And they use that as a means of circumventing these rules. And that's really where they've come in and tried to avoid that.
Okay, going to the proposed regs, a couple of broad topics. Obviously, they're going to be extending the reach of the regulations now, because when we went on the prior slides and I introduced the sections, the code sections under Chapter 14, I said they apply to corporations and partnerships. Well, that no longer is going to be the case. We're going to talk about other business arrangements, and the way that attorneys were getting around that is they were using LLCs. Well, now LLCs, regardless, even if you're disregarded by the federal government, meaning you're a single member LLC, you're also going to be part of the regs. So they're going to be extending their reach to determine what constitutes control. So that is something that is huge for us when we're trying to determine what in fact control is. Aside from extending their reach to these other entities, they're expanding in the way that we actually look at control. They're expanding the historical definition of control to include these indirect interests that are held by entities that are not corporations and partnerships, LLCs. They're actually going after assignee interests as well. And then what's very interesting in these proposed regs that's very scary is that control is defined as holding at least 50% of either capital or a profits interest in the entity. That's kind of scary, because you can have actually two sides of a family each owning 50%, but by definition of the proposed regs, they each have control. So that those discounts are gone from either side. It will also include alternate means for determining control. If you have an interest that actually causes you to have full or partial authority to liquidate the entity, there's going to be a control attribute to that as well. And then it's going to expand attribution rules. It's going to expand who is determined to be a family member. There are certain listings of family members in the current regs. That's going to expand as these proposed regs come along. Lapses, liquidation rights, and deathbed transfers. One thing that we need to understand is the definition of a lapse is going to include any transfer that results in restrictions or eliminations of any rights or powers associated with the transferred interest. And then there's going to be limitations in defining lapse of a liquidation right with respect to deathbed transfers. So the exception that's allowed now under 2704A is only going to be applicable if that transfer has happened 3 or more years before the transfer's death. So anytime that there is some estate planning, the transferee or the transferor passes away within 3 years, no discounts are going to be allowed. The full pro rata of that interest is coming back into the estate. Then they're going to be expanding applicable restrictions. They're going to be adding new applicable restrictions under 2704B.
And they're adding disregarded restrictions. I'm not going to go through them all, but this is a new class of restriction that deals, again, with the valuation matters, and basically is a disregarded, as the name implies, restriction in conjunction with determining value. So that's really what we have in these regs. We have a ton of little problems that are in these regulations that people are contesting. And in the time we have left to just give you kind of an overview. One of the things they do in here is define control as 50%. So it's kind of a bizarre thing, because I don't think anybody in the room would suggest that 50% controls an enterprise. And so you could actually have two families each owning 50% of a company, both of them deemed to have control in that company and not be able to adjust the valuations for transferring at death for the risk attendant without having a real true economic control position under state law. There are just all kinds of little limitations on there. The big thing is that we don't see it as producing fair market value. And that's what the valuation community is particularly concerned with in conjunction with these rules, is that we have a position where we have been asked over decades long, and dating at least back to 5960, but probably well beyond that, almost back to ARM 20, which was the first creation of fair market value in the context of tax law. And those laws were passed in 1920. to be able to pay people that had their businesses closed down because of the prohibition laws. So it's a long time term. If we're going to have a situation where we're doing a valuation of one of the companies you work for death tax purposes and transfer tax purposes, and we have to basically disregard legal restrictions that are already written into the governing documents, then we have a problem from a professional standard standpoint as a valuation community. What we will be doing is not fair market value, and we're going to have to describe it as such, or we're going to have to do a hypothetical valuation because we're hypothetically suggesting that these legal requirements have no merit in conjunction with this particular valuation. And from that perspective, we're in trouble. The rules, as I said, were published on August 2nd. We submitted comments to Treasury. I spoke with a woman at Treasury yesterday. They have 7,500 comment letters on these rules in 6 weeks. There's a public hearing on December 1st that I'll be testifying down there on behalf of NACFA, the National Association of Certified Valuators and Analysts, and they have 340 people right now that want to speak. It's in 10-minute increments. That ought to be interesting, a couple days, huh? So you get to sit there and listen to the same people drone on. But just so you know, the impact of these is going to be absolutely incredibly significant if they're finalized in their current form. I would suggest that that's going to be changed and pulled back simply because of the response from the valuation and the estate planning community within the American Bar Association, and that we will see a little bit of a pullback on this. We do have information on our website on this item, an article that Melissa and I have authored that's about 15 pages long. If you're really bored, you can read through that. That's going to be published soon. And then we also have the connection to the response letter from NACFA to the IRS if you want to read the comments. So that's the development that I think is the most key development we've seen in several years in valuation. Let's hope for a pullback and that we don't see this thing being finalized the way it is. Thanks a lot.
Thank you.